All right, let's talk about Paychex. On the surface, their latest earnings report looked like a home run, a classic beat and raise. But then, the stock dropped. So what's the deal? Here at Talk Tickers, we're going to dig in and find out exactly what the market saw that the headlines completely missed.
So here's how we're going to crack this case. First, we'll look at the market's weird reaction. Then, we're diving deep into the numbers, specifically a tale of two different margins. After that, we'll listen to the tone of the earnings call. Read between the lines. We'll lay out the classic bull versus bear debate this created, and then wrap it all up with our take for the next call.
Okay, first up, the market's verdict. And honestly, it was confusing. This is really where the whole mystery kicks off.
So, let's start with the good news, right? The bottom line looked fantastic. Adjusted earnings per share, or EPS, came in at $1.26. That's a solid 2.4% beat over what Wall Street was expecting. You can't argue with that. It's a clear win.
But, and there's always a but, isn't there? Here's where we see the first crack in the armor. The top line, revenue, actually came in just a hair under what analysts were looking for. Now, a 0.8% miss isn't a disaster, but believe me, in this kind of market, any little hint of softening demand gets put under a microscope.
And this is the result. This is the big head scratcher. Despite that earnings beat, despite raising their guidance for the future, the stock closed the day down 1.72%. And it wasn't on light trading either. It was on heavy volume. The market was basically shouting from the rooftops that it was not buying what Paychex was selling.
So that brings us to the million-dollar question, doesn't it? A beat and raise. So why on earth did the stock fall? Well, the answer isn't in the splashy headlines. You've got to dig a little deeper, into the nitty-gritty of the report.
And where we're going to find our answer is in the margins. You see, this report tells a tale of two completely different margin stories. And it's right here that we find the clue, the thing that really spooked investors.
Okay, let's just lay the numbers out. You see that revenue miss we talked about? Right next to that solid adjusted EPS beat. But look closer. See the GAAP EPS? That's the officially reported earnings. It's actually down from last year. And that, my friends, is our first major clue that something's going on under the hood.
Wow, okay, this chart right here tells you almost everything you need to know. Look at that. Revenue growth up 18% year over year. That's pretty good, but it's completely overshadowed by this monster jump in total expenses, up a whopping 27%. I mean, when your costs are growing that much faster than your sales, your profitability is getting squeezed hard.
And this is the smoking gun. This is where it gets really interesting. Look at the split here. The official GAAP operating margin, it actually fell. But the adjusted margin, the one management wants you to focus on, went up. So what's the difference? Well, it's about $77 million in costs related to their big Paycor acquisition. And smart investors saw that adjustment and thought, maybe the quality of this earnings beat isn't as good as it looks.
Okay, so we've looked at the numbers. They tell us what happened. But to really understand the why, we have to listen to what management said on the earnings call. Read between the lines. Our first clue comes from the CFO, Bob Schrader. He was asked directly about that softness in revenue, and he admitted they're seeing a little bit smaller deal sizes. Now, that might sound subtle, but in analyst speak, that's a blinking red light for a more cautious spending environment.
And the CEO, John Gibson, he pretty much backed this up. He painted a picture of a customer who's, being really careful with their money. They're looking for value, managing their costs very carefully. Basically, they're pinching pennies and scrutinizing every dollar.
So if you put all the pieces from the Q&A together, the picture becomes pretty clear. Management's tone is cautious. Yeah, demand is stable, people are still buying, but they're being very cost-conscious. They're shopping around more, and they're picking the lower-end product bundles. And that change in customer behavior, that's a huge piece of this puzzle.
So what you have here is a classic investor's dilemma. You've got two completely different stories playing out at the same time. And depending on which story you believe, you're either a bull or a bear on Paychex. Let's just break it down side by side. The bull case, this is what management is focusing on, is all about that adjusted EPS beat and raise. The growth they're getting from Paycor and their shiny new AI roadmap. It's a forward-looking story. But the bear case, which is clearly where the market landed, is all about the here and now. That revenue miss, those soaring expenses, the margin pressure, and all that talk about cautious buyers. See the conflict?
You know, this whole thing is a textbook example of what we call a beat and raise but scenario. It's a classic situation. A company posts great headline numbers, raises guidance, but the stock still falls because savvy investors are looking past all that and they're seeing underlying concerns about the quality of the earnings. They're asking, yeah, but is this sustainable?
So, after peeling back all those layers, where does that leave us? What does this all mean for the next quarter and beyond? All right, here is our take for the next call. For the third quarter, we're forecasting results that are pretty much in line with what management guided to. No big surprises there. As for the stock price, we think it's going to be pretty much range-bound for a while, probably testing its recent lows until we get some real clarity on those Paycor integration costs and what the organic growth really looks like. So the raised guidance provides a nice floor under the stock for sure, but those expense headwinds create a pretty solid ceiling. For all those reasons, we're initiating our rating for the next call at market perform.
And just as a final reminder, this is not financial advice.